Hey everyone, this is Robert Keene, so goldsilverpros.com, and I'm going to give you an update on the gold market today and show you why gold punched through its all-time high of 1900 to about 1977 we saw yesterday. Let me show you guys what I'm seeing on the chart. So the high was actually about 1977. We're trading in the 1930s today, so there was a little bit of a pullback. But there are reasons why we punched through the all-time high. We'll go through that really quickly, and then I'll get back to the chart and show you where we may be going in the future. So I wanted to start off with ETF Fund Flows. You can look here at etffund.com and check out the ETF Fund Flows. The GLD, which is a derivative proxy for gold for a lot of investors, had the most net fund flows out of all of the ETFs tracked by ETF.com from 721 to 727. So basically the last week, we saw all of these flows into the GLD, dwarfing what we saw into, for example, the Bloomberg High Yield Bond ETF or the Core US Aggregate Bond ETF or the iShares Gold Trust. Now we're seeing, this is a gold trust, we're seeing a lot of fund flows into gold there as well. If you add these two numbers together, and it basically triples almost, or 2.5 times what the next fund was if you add these two gold ones. The triple Q, then you see the silver trust. So the precious metals are getting a ton of flows into them, and that's why the price is rising. We're going to also go to look at COMEX and look at the open interest. Those of you who saw my silver futures video about a week and a half ago where I predicted a rise in the silver price about 4 days before it happened, what I was doing was I was looking at the futures market, because the futures market is really where the gold price and the silver price are determined. So here we have a report, Monday, July 27th from a CME group, which provides these statistics for us on the futures market on the gold futures. And as you can see here, the total volume is 604,752, which is a really high number. And this is for all the base metals. So you see that gold has the highest open interest of any of the base metals, more than silver, more than copper, more than platinum, palladium, aluminum, Shanghai gold, Midwest busheling ferrous, which is iron, zinc futures, uranium, so on and so forth. It by far had the most open interest, meaning the players in the market interested in taking a long or short position in the futures market are in gold, and secondly, they're in silver. So the precious metals are getting tons of interest in the futures, and that's why you see the price action in both of those metals that you see much more than you see in the rest of the underlying resource sector. I wanted to take you over here to a monthly report on gold, and I want to pay particular attention to, this is the COMEX gold, and these two columns. This is volume year-to-date 2020, volume year-to-date 2019. You're seeing a 15% increase in the volume on the CME for gold year over year, 2020 over 2019. That is a substantial increase, and again, one of the reasons why you're seeing so much interest come into gold is that you have all of this open interest, and the actual volume of trades is up 15% year over year. So that tells you that the longs are coming in and bidding up the futures price of gold. And therefore what we do is we have gold punching through its all-time high just over 1900, about 1901, getting up to 1977 yesterday and settling in today about the 1930 range. There's one other thing that I wanted to show you as well. What we did in the silver video is we looked at delivery notices. What's a delivery notice? Well, when you're in the futures market and you take a long or short position, you can settle in cash. There is a clause in the contracts where you can settle as cash. This allows speculation in the market without actually having to take or provide physical delivery of the metal. However, one thing that tends to drive a lot of the metal prices is when people stand for delivery in the futures and say, no, I want the actual metal, because there's only so much metal in the futures market to actually back up all the futures positions. It is a leveraged market, meaning that there's many more futures positions long and short than there is actually metal stored upon the depository. So if we look down at the totals here, as of 7/27, we see something interesting in May, June, and July, and actually going back to April. Basically, it started as soon as COVID started. You saw this massive spike in people standing for delivery of this 100-ounce gold futures contract on COMEX. You see 31,666 contracts of 100-ounce gold in April. You see 10,277 in May. And I believe that was the reason for that in May was because the first wave of COVID had kind of settled down a little bit. Places started opening up back in May. We had some optimism in the economy. Maybe we're through COVID. And then you saw the COVID numbers spike again here in June. So you saw a record amount for this year, 55,102 contracts, each of 100 ounce of gold, standing for delivery in June. And then so far in July, we have 8,781. So to give perspective over how much gold that is, we're going to take this 55,102 number and we're going to multiply it by 100 ounces of gold per contract. And in June alone, we had 5,510,000 ounces of gold, or long standing for 5.5 million ounces of gold on the depository. That is a substantial amount of gold. If you multiply that times the gold price right now of 1931, from a dollar perspective, you get this really big number. It's $10 billion of gold. Now, what does that mean in terms of the overall amount of gold actually in the warehouse at COMEX? Well, let's take a look at the delivery report. So as of 7/27, this is the CME metal depository statistics for gold actually on the COMEX. Now, remember from the silver video, we talked about the different categories, and the two main ones you want to pay attention to are registered and eligible. Eligible is basically storage, but it's not eligible for delivery against contracts. Registered is registered for delivery against contracts, meaning you expect that amount of gold potentially to go up against a contract where you can actually deliver it. Whereas eligible is more, hey, it's just stored here for safekeeping. We're not really going to put it up against the contracts, but it's here just in case. And think of that like the backup account. So here's your main, like your checking account is registered. That's where you're going to spend your money out of your checking account. Eligible is like your savings accounts, like the money you keep in there in case, I want to go out and have a night on the town. We need a couple extra $100. Let's move money from savings to checking so that we can use that check card. That's essentially how this works. But I wanted to highlight some of the increases in registered. A couple of the big boys, HSBC Bank USA increased, and this is one day from the previous total the day before to the 24th, increased 58,000 ounces in the registered category, meaning they expect to deliver potentially 58,000 more ounces of gold against their short futures positions. And going down here, you also see the Bank of Nova Scotia doing 38,402. Of course, you see some other people doing less. You see Malka Amit USA moving 22,000 out. But the net for the day was an additional 89,429 ounces into the registered category. And overall, we can see the combined total of 35,133,000 ounces of gold available on COMEX, basically for delivery. Only 13 of that and immediately and registered, the rest and pledged and eligible. So if you go back to this number of July, people standing for this number, 5,510,000 ounces of delivery, we have just basically double that total in the market right now registered for delivery. Now they can bring an extra 22 million ounces to bear against delivery. But if we go back and look at the trend, I mean, if you look at these numbers, 31,000 contracts, 10,000 contracts, 55,000, 8,000, it's averaging about 25 or 30,000 contracts for the last 4 months standing for delivery. So it wouldn't take long really to drain out all of this 35 million ounces. If you're going basically 5 million ounces at a time every month, it would take about 6 to 7 months. So think about it like real estate. If you're going to go buy real estate, you ask your real estate agent, what's the inventory in Dallas, Texas, or Chicago, Illinois for houses, and how many months of inventory do you have? If you have 3 years of months of inventory, that means housing prices could be depressed because you have more inventory or more supply than you have demand. Same thing happens on COMEX for registered ounces of gold or silver available for delivery. If you, right here, we have about seven months of inventory given, the recent numbers that are showing up standing for delivery. Here, the year-to-date delivery notices on the COMEX are averaging about, 25, 30,000 ounces a month. That means you have about 7 months of delivery available, these 35 million ounces available, and only about 2 months immediately available. So let's say I'm going to the futures market, I'm going to put in I'm going to stand for delivery of that gold at the same rate that's occurred since COVID. That means we have about 2 months of available inventory, but an additional 5 months inventory we could bring to bear if we absolutely needed to. 7 months of inventory is not an excessive amount. It's a fair amount. It means it's still a liquid market. Real estate agent would say the same thing. If you had 6 or 7 months of inventory in the market, say that's a very liquid market. It's about even between buyers and sellers. I would say gold right now is about even between buyers and sellers. But look at the tick up. Traditionally, we don't have that much standing up for delivery. Some months we do, some months we don't. But it averages probably 5,000, 6,000, 7,000 contracts of 100-ounce gold. Now we've jumped up since COVID to 25 to 30. That means we're going to drain that inventory much faster. That means there's going to be a run on physical gold. That means there's more demand on physical gold. That means the longs are standing for gold are beginning to win this battle of gold futures on the COMEX. So if you add that to the fact that we have all this massive amount of money going into this gold trust, number one, you go down here, number 4, this gold trust, you go down silver trust, number 6, the precious metals are getting massive inflows into all of these derivatives, the futures positions on the COMEX I just showed you, as well as the fund flows into these derivative investments, GLD and SLV. And that's why you see the prices rising. And that's why you see, even absence an immediate banking crisis, the price of gold go past its all-time high. People are bidding this up. Certainly last week, we saw the GLD on the Robinhood app reach number 16 in terms of investment flows. This means the younger audience is coming into gold and bidding up gold through the GLD as a proxy, as a safe haven asset. And it's starting to get money from the younger generation. They're starting to be attracted to gold as well. I believe when you look at this time period from 2011 to 2016, and even as far as up to 2019, the young money was not coming into the gold trade here. This is basically the people that have been in gold traditionally, the baby boomers and my generation, the Gen Xers, who traditionally seen gold as money up until 1971 when Nixon releases from the gold standard, and before that. The millennials, the Gen Zers are just now starting to have money and become adults and become aware of investing. They weren't putting money into there. I think this is when they started putting money into it. It was at the end of 2018 when the stock market had that 20% correction. I think that woke a lot of people up and they started looking at alternative investments. Certainly Bitcoin is one, but obviously gold as well. And you can see that money coming from the millennials into the market. Now, on to the part of the video you guys want to know. What's Rob's prediction as to what's going to happen to gold? To be honest with you, this is going to be a little bit more difficult than silver. With the silver chart, we weren't at all-time highs, and we have been sitting, at a depressed level for a long time. So once I saw that volume activity spike up in silver, it's very easy to call an uptick in the price of silver. I also called an uptick in the price of gold in my article, Gold is in Gorilla Mode, but it's hard to tell what level that's going to go to. I think certainly we saw gold go up to 1977, and then it's retraced or come back down to 1931. It still has this perfect cup formation this way. And I've talked in previous videos, a cup formation is very bullish on a technical chart for any chart that you're looking at, whether it be a stock or a bond or a metal or whatever the case may be. An even more bullish chart is when you have a sizable retracement down here and it forms a little handle. So you get this little cup, you pour your tea, you get this little handle you can hold your tea on, like that. When you get that little retracement, some people call that a ladle, like a ladle in a pot, or some people call that a cup handle. Whatever that is, it'll get down to somewhere in this level, and then you see another massive bull market come up like this. That's not uncommon. In fact, this little down, if we go back here to 2009, this little downtick in gold is sort of like a handle. It's where gold reaches a certain level and people begin to take profits. They sell their derivatives, they sell the GLD. Maybe they, less longs are on the futures market and it retraces back. That's normal in a market. Rarely do markets go straight up unless you're in the middle of a crisis. But even the last time we had a crisis, going back here to 08, 09, when we had the mortgage crisis, gold was sold off. Why was gold sold off before it did this meteoric rise to an all-time high of 1900? Because people had to take profits. People needed liquidity. So they're going to sell their GLD. They're going to sell, whatever derivative form of gold they have. Now, you can see by this price rise that the people that had held physical gold didn't sell a lot of it. Some people did. My friend Lynn Alden said during this time period when it was rising, she sold her gold coins. And that was one of the best trades she ever made. And very happy for her. Lynn's a very popular writer, and I respect her very much. But a lot of people held on to that gold. And I think right now we're having a lot of people hold on to their gold right now. And you're seeing that activity, in the futures markets and the GLD. But I do believe we could have a normal retracement. We could come back to one of these lines. Now, the $1,722 line is basically the 50-day moving average. That's a very natural retracement. Okay. And that's about about a $160 retracement. People say, oh my God, we're retracing $160 in gold. Panic, panic, panic. Don't panic. This is normal. Retracements are normal. They happen. Look at the rise from '09 to '11 in the gold market. Retracement, smaller retracement. As the retracements get smaller, that tells you the bull is going stronger until you have this near vertical and then retracement, bounce around, and then come back down. That's normal human sentiment. It's human sentiment and how we look at markets. There's going to be some profit taking. So gold has had this really nice run up. There was a little blip of a retracement, and then you kind of had the COVID thing, and it went whoop right back up here. So we could have another bigger retracement down like we see here or even here, and then it could resume its bull run. And I don't even think we're done there yet, because remember in 2008, 09, we were talking about a crisis. Do we have a COVID crisis? Yes. Could it retrace during the COVID crisis, people taking profits much like they did in the financial crisis? Yes. But the difference is, I don't believe we have the final numbers on the COVID crisis yet. I think it's going to lead us into a deflationary depression. I wrote about this as my book in 2010, Drop Shadow, The Truth About the Economy, when I predicted something would bring the economy down, and with all the debt and all the leverage we have, we would have a clean out. We would have some sort of reset. And that's what I wrote about 10 years ago. I think COVID has pricked that bond bubble. We're going to have that reset. And I expect gold will sell off. Now, could gold reach 2,000 before it sells off, or 2,100? Absolutely. Depends upon the timing of the event. But when you start to see these bond problems in the market, the banking problems, this crisis start to bubble up to the surface, where you're seeing in the mainstream financial media, not just guys about me have been talking about for 10 years, but the mainstream media is saying, oops, we have a problem in the debt markets. We have a problem with the banks. And this can be anywhere. It can be China. It can be South America. It can be the United States, because it's all interconnected. When you see this global banking problem, this global debt problem start to take form, that's, I believe, when we'll have the last bit of the last sharpest move of the gold bull market. But we could definitely see some retracements and some steps higher like this along the way. I think it's going to go like this, and then there's going to be a crisis. It's going to come down, then pop, it's going to go up. So where does that leave us? Well, at goldeagle.com, where I provide my predictions, they ask 1 year, where do you see the price of gold? I said 2,500. They said 3 years. I said 3,000. I think 3,000 is very conservative. We could be at 5,000, 6,000. Depends upon the scope of the problem. But in my predictions, you can see that I think we're going to stair step up like we are now. We'll have some retracements along the way, but then it's going to continue to rise. And then we're going to have a crisis. It'll come down as people liquidate. And that's where you want to make your last buy. When you see that last big retracement in the middle of the panic, in the middle of the maelstrom, buy there. That's your last dip. There will be no more dips after that. Then it'll go near vertical, just like it did here, and it'll go pop right up to the top. And that will last probably for a couple of years after that crisis, until which point people are like, okay, I think we've averted the crisis, or we know what the crisis is, and we may start to take some profits. That's kind of the shape of what I see are things to come. Worst case scenario, in forming this cup or this ladle, could we come all the way down to 1622? That's the 200-day moving average. You can see by this red line. I drew this green line across here. Possibly. The 200-day moving average coincides with a little level here between 2012 and 2013. So it's a double psychological level. It's psychological from the previous time gold was in a bull market to now, the 200-day moving average now. Could we come down to 1622? Possibly. It's about $300 off of where we are right now. Do I think that's going to happen now? No. I think the fund flows, the open interest, the amount of contracts being settled on the futures market, look at these numbers, point to the fact we're not going to have a super sharp retracement, maybe 1722, maybe 1700, maybe possibly 1622, but I think it'll go back up here and it'll do this until we have the big crisis, and it's down and up, that sharp down up till you reach the peak. When does that happen? Look at the debt markets. Follow the debt markets, follow the banks. That's when you're going to have your last big leg up in the gold market. And I don't think it's going to take that long for that to happen. So this has been a bit of a long video, guys. I really wanted to get into the short, the intermediate, and the long term of gold to kind of help you guys see that picture, looking at the charts, looking at the derivatives, looking at the fund flows. I think this gives you a really good outline for what could happen to gold. As I wrote last week, gold is in gorilla mode. I don't think it's coming out of gorilla mode. We're not going into a bear market, but expect to see some plateaus and some retracements along the way. Don't let it shake you out of your position, certainly if you hold the physical. Hold on to that physical, buy the dips, dollar cost average in. If you're in the stocks, do the exact same thing. If you believe in speculating in the stocks and getting that leverage to the gold price, buy the dips, continue to invest in the gold sector until we have this reset or this flushing out of the economic system. Gold is not going to sharply retrace back to previous levels. I don't see that happening. So this is my view on gold, guys. I hope this helps you out quite a bit. Till next time, this is Robert at goldsilverpros.com.